Good morning. I'd like to welcome everyone to part 3 of our series on credit scoring and data innovation, opportunities in SME unsecured lending, hosted by SME Finance Forum in partnership with CapPlus Exchange and presented by Tom DeLuca of AMP Credit Technologies. Thank you so much for joining us. Thomas is CEO of AMP Credit Technologies, a wholly owned subsidiary of Advanced Merchant Payments Limited. The company is a financial technology company that enables banks, non-bank financial institutions, and other business service providers to deploy alternative lending technologies for the financial inclusion of their small business customers. Prior to AMP Credit Technologies, Mr. DeLuca was a co-founder of Planet Payment, a multi-currency payment processor, and worked in the legal department of American Express, where he provided legal and strategic advice to the Merchant Services Division. Mr. DeLuca received his BA, GD, and MBA from St. John's University and his LLM in International Trade and Business Transactions from Fordham University in New York. And we do have several more upcoming webinars as part of our ongoing series. We have 2 sessions in June and July on sales and sales management practices, and then we start another series on innovations and product development with linking financial and non-financial needs of SME clients and women entrepreneurs in August. We do invite you to join these events, and you can see the entire program and register at the link below. We encourage you to send the calendar to those who would also benefit at your institution, and videos of all of our completed webinars are also available at the website listed here. And at this point in time, I'd like to now introduce our very experienced facilitator, Thomas DeLuca.
Thank you very much, Jessica. So we have a lot to cover today, and thank you very much for allowing me to present. I'll just go quickly through the agenda. Certainly a little introduction to our company, AMP Credit Technologies, and our background for being able to present here today. We'll talk about the opportunity for banks, and of course this should say banks and other institutional lenders, certainly not restricted just to banking institutions. We'll talk about the small business lending technology and the solutions for deploying that amongst banks and financial institutions. Then we'll get into more detail on our new approach to credit scoring using what we refer to as electronically verifiable cash flow. And finally, we'll refer to a few case studies along the way. So a little overview of AMP Credit Technologies to give you some background into the subjects that we're going to cover in some detail. We are principally a fintech company designed to operate quietly in the background on behalf of banks and other institutional lenders so that they can utilize what's referred to as this alternative lending methodologies coming out in the industry that allows banks to lend to small business customers in a way that they had not done so before. Our original name of business was Advanced Merchant Payments. We launched in 2010, and with over 5 years of effort, with our own loan books in Hong Kong, Singapore, and Philippines, and now just launched in the United Kingdom, we've achieved roughly a 50% average net effective rate on the portfolio, with a net loss, default loss of just under 2.7%. Now, you could say a lot of things about the net effective rate, whether 50% is good, bad, and different. Certainly an element of that is the cost of capital for our young business. But really, when you think about it, it's not much higher than the cost of credit card debt in most markets, and well below the cost of the informal economy to which small businesses are going. The key thing there is that over a period of almost 5 years, you could deploy in both developed economies and emerging economies using these methodologies and achieve a profitability on the portfolio which allows broader access to financial inclusion for underbanked small business customers and an opportunity for the financial institution to provide service to its existing customers. Our core proposition is to partner with these financial institutions, principally, again, on a white label processing basis, but we're also prepared to put skin in the game, as in the other markets I referenced above, and take risk on the loan profiles that we generate. And we're very pleased to say we're recognized for our commitment in accelerating small business growth and financial inclusion as a founding member of the SME Finance Forum. Most recently, something we're proud of, it was an award from Retail Banker International for most innovative concept in promoting financial inclusion. And in the United Kingdom, we're a founding member of the Innovate Finance for them. So we're rather proud about that. I suppose one thing that's useful is just talk about by way of our background, because one of the questions that will often come up, merchant payments obviously being a credit card driven industry term, the background of our company and ourselves that we are payment processing guys, having built in prior opportunities payment processing platforms that banks would use on an outsourced basis very quietly with us in the background. And so much of the model 5 years ago was premised upon sitting in credit card transaction flows and divining from that information variable insights into the small business behavior relative to cash flow and capacity to potentially repay a loan and the character of the borrower. Part of the rebranding that we've gone through is to recognize actually what we've learned is that this is much broader than just merchant payments. It's much broader than the credit card industry. And in fact, we could deploy our technologies wherever there's a reliable stream of what we refer to as electronically verifiable cash flow. So hence the rebranding exercise from advanced merchant payments to a much broader application of this technology to our credit technologies business. So some examples of which type of borrower can benefit from this. And again, this is from our own experience to give you some indications. Again, both developed and emerging economies, roughly 38% of our borrowers are female, women-owned businesses, and as I'll speak later, I think it's a great opportunity to promote financial inclusion amongst small businesses owned by women. Interestingly, on the age differences of the typical borrowers within our portfolios, you see quite a bit, almost half represent age 45 years and older. And of course you see 35 to 45 breaking up a big piece from there. And then the newer entrepreneurs, 20 to 35, who would typically have significant difficulties obtaining access to capital because they wouldn't have collateral, they wouldn't have had the history to build up credit records, would certainly benefit from us as well. The industries is frankly a very broad range of industries that are able to be serviced. More than 110 what we refer to as merchant category codes, essentially discrete standard industrial classification codes, benefit from the business today. It could be much broader. This basically anybody. It could be in the food and beverage sector, retailers, service sector, medical equipment, doctors, dentists, veterinarians, optometrists. Anybody that's very much in a business to consumer or service sector or retail side of business would tend to be able to borrow utilizing our methodologies at a very effective rate. As important, these are the same types of businesses that would not typically have access to traditional SME financing. These are businesses that would not have collateral typical to a business. They wouldn't have a truck, a warehouse. They wouldn't have accounts receivable, invoices, or any other type of traditional asset that a bank's SME department might provide funding against. Rather, these are businesses that would almost never have collateral that would lend it. If it's a restaurant, obviously no collateral. A retailer would not likely have collateral that would be worth pledging. Certainly service sector, no collateral. So that's where we look at one of the big product gaps that banks have is somewhere between sole proprietor loans that are largely underwritten based upon the personal credit score of the borrower, the sole proprietor, and the collateral that person would have at the bank, and then certainly on the other end of the bank product spectrum, where you have heavily collateralized businesses that are typically much more mature, and the loans therefore take longer to underwrite. The banks therefore, for it to be efficient, need bigger loan amounts. So really what we're talking about is a product to address a significant element of financial institution customer base for which today no products would exist. So with that, by way of background, we'll launch into the first poll. And I'll turn it over to you, Jessica.
Great. So we'd love for you to vote at this point in time. We're actually going to do two polls. So we'd like to hear from you if you're currently engaged in any type of unsecured lending at this point in time. So this is going to be a pretty quick poll. So we'll take about 30 seconds here. And so we're seeing some responses come in. And we're pretty evenly split here at this point in time. So we'll take another 10 seconds or so for this poll. And so if you haven't put in your vote yet, go ahead. And we'll go ahead and close it. And Tom, what we're seeing, about 56% are currently engaged and 44% are not engaged at this point in time. And we have a second poll that we'll jump into here as well. And so what we'd like to know, especially for those that are not doing it, what is the biggest hurdle that your institution has faced in terms of entering or expanding the SME lending at your institution? So if you could choose one of these, first is shorter loan tenors limit profitability. The second is smaller loan sizes fail to deliver scalability. The third is inadequate credit referencing sources for effectively assessing credit worthiness. For example, lack of credit bureau for business, incomplete financial statements for newer businesses, or no collateral. The fourth is inability of current technology platforms to accommodate needs of SME lending. Or the fifth is if there's some other challenge. And if there's another challenge, please feel free to post that answer in the chat box, because we'd like to get that. So we'll have this poll open for about another 15 seconds or so. So if you can choose one of these. So is your biggest issue the shorter loan tenors limit profitability, smaller loan sizes fail to deliver scalability, inadequate referencing, inability of current technology, or some other type of challenge? So we'll take another 10 seconds here. If you could choose one of these. And Tom, overwhelmingly, we're seeing the inadequate referencing. So almost 70% of the participants are saying that the inadequate referencing for assessing credit worthiness, and around 16% are saying the smaller loan sizes.
Okay.
11% are saying other challenges, and 5% inability of current technology.
Okay, excellent. So with that, I will carry on, because what that is saying to me, in a way, all of those choices are interlinked with the overall ability to profitably originate loans to a category of customers, which is interesting to see which of those would be viewed the most. I would have expected a little bit more of a spread, but the 70% focusing on inadequate credit references. I suppose if enough information could be done for the institutional lenders, particularly with character and capacity assessment, which made it presumably distinctly cheaper to complete the origination, then it would be okay that it was a shorter loan tenor or a smaller loan size in terms of the profitability of that. So that actually comes through very, very clear. So with that, I'd like to jump into the next section, talking about the opportunities, because I think that's a perfect segue. Because I think what we're trying to focus upon here then is, where does this opportunity sit? And it's sort of a core argument we make that was missing within the banks at the moment, and again, banks writ large, financial institutions, is that there is a product gap within existing banks. So the core context of most of the rest of the presentation is a means not just for credit scoring, but effectively credit scoring with respect to a formalized product that currently is not formed by banks. There's certainly great opportunity to use these methodologies to improve marginal acceptance rates on existing products. If I could just put it out, so to me, the biggest, or a very significant business opportunity is actually creating a new product for the micro, small, medium-sized enterprises driven by unsecured cash flow behavior. This product gap, we know, is being served today. It's not that these small businesses are not borrowing. They're borrowing from the informal sector. And of course, increasingly by technology-driven alternative lenders, certainly out of some of the developed economies, but certainly much innovation happening in a number of places, whether it's Kenya, India, Colombia, is just certain examples. So for the bankers who manage P&Ls on this call, the core proposition here is that low-hanging fruit is filling the product gap by providing
unsecured cash flow driven loans into their underserved small business customers. It's really what we're looking at, who could benefit from it. The typical bank structure would be designed, there's existing loan products, usually driven from the retail side or consumer loan side, is the key determinant. So sole proprietorships, is there any money in the account? Do they have a mortgage or so with the bank? That's where we work. It's real estate, but it has to be unencumbered real estate, which goes to show if you own your own home and it's not encumbered by a mortgage, you almost certainly don't need to be borrowing to be funding your business. On the other side, commercial banking tends to focus upon larger SMEs, as we all know, and those financial products tend to be collateral-based. If you're a sole proprietor, personal credit score, on the other end, you've got products driven by collateral, which, because of the nature of evaluating the collateral and, first of all, the value of the collateral, but also the legal rights relative to that collateral, you're looking at very expensive underwriting costs, and therefore you're looking at, on a cost-efficient basis, banks looking at larger transaction sizes to make that worthwhile. What that leaves in the middle is a very significant body of customers known to these financial institutions, usually account holders, who cannot or will not qualify for those products. These could be people with poor personal credit score, and of course, as a small business owner, you would be well understood to have poured your personal credit into keeping the business going. So I think it's very well proven out, certainly by our own 5 years of lending, but certainly by reference to other sources of the market. The fact that small business owners tend to have personal credit scores, poor personal credit scores, is not dispositive of whether they're going to repay back business loans. I.e., there's not a direct correlation between a small business owner having a poor personal credit score and that person's character or capacity to repay a loan for business purposes. However, any product that is fundamentally based upon that would naturally decline these people. Businesses that have been around for less than, fill in the blank, 2 years, 3 years, particularly if it's driven off of financial statements or tax returns, given the time lag inherent in that, most existing bank products would anticipate financial statements, which essentially means business has to have been around for 2+ or 3+ years. Given the well-understood statistic that most businesses fail within 7 years, I guess is what the notion is, there's a high turnover, although the entrepreneur would need to continue to restart and restart. There's a high volume of customers within a bank who would not be able to fit within because they'll always be relatively new. So there's a good opportunity to service customers of a younger age, whereas the business of a younger age, even though they may not be able to produce 3 or 4 years of good financial statements. Leading to the next point, obviously, incomplete financials, as we just discussed. Different countries have different approaches relative to financial accounting and what's required. But anytime you're engaged in financial statement underwriting, it's certainly going to be an expensive manual process, and therefore mitigating in favor of only larger transaction sizes. Obviously, we spoke about collateral, but this is an important point. There are many, and I think our business proves this out. The average age, again, at our bar is 6.5 years. These people could be in business for 20 years, and they will never have collateral. These are typically business to consumer, we would say B2C or service sector, anything from retail of any variety to food service, any kind of kiosk, even modern day e-commerce businesses, beauty salons, anything of that nature, even doctors, dentists, which we provide service sector, are not businesses that will ever have collateral. So if as a bank you're designing a product premised upon collateral, you are off the bat excluding a significant portion of your customer base. And of course, loan size and speed to loan have become a very important factor as well. And oftentimes a small business customer, particularly in a volatile cash flow environment, needs a relatively small amount of loan, which again goes to the profitability of originating that loan, but often need it quickly. And this is something not just for small business, but even larger sized businesses might say, as some of our customers have, Tom, I'm very capable of getting a loan from my bank, but it's going to take me 4 months to get it. I have a very specific business need. I need to get it quickly. I'm prepared to pay more for that service. So I can take those needs. If you think about designing products that solve that need, that's the product that we're really speaking about. Although again, the methodologies could be deployed across existing products, whether it's leasing or basically collateral-based loans. I promised to talk about women-owned businesses because this is something that's quite important to me personally and to AMP as a corporation. When you think about businesses, banks, financial institutions that are trying to make efforts to women business financial inclusion, there are some things that we've seen that I think need to be effectively rethought, but a rethinking or reapplication is what we're talking about. There are a number of statistics. In fact, a recent Experian major credit scoring agency came out with a report a few weeks ago on gender imbalances in small business lending. Certainly something well known, well documented by, amongst others, certainly the SME Forum, Women's World Banking Association as well. Women-owned businesses tend to be in, let's say, non-collateral intensive businesses, service sector, retail. And I realize I'm making broad statements, but one of the key elements there is that these are businesses which are heavy cash flow transactions, lots of transactions, increasingly driven by electronic transactions. And so as a neatly defined customer base, there's the opportunity certainly to define a electronic cash flow driven unsecured loan product towards businesses owned by women. And as I indicated before in our statistics, almost 40% of our historic borrowers have been women-owned businesses. And obviously, this is something that's very important to us. So I think it's worth making a point there. If on this webinar there are banks who are thinking about strategic initiatives towards promoting financial inclusion for women-owned businesses, I would encourage you to think about this perhaps from that perspective as well. So let's give a couple of introduce the first case study of where we are. This happens to be a Hong Kong business, a real case study, a business that came to us about a year into its existence, and a woman-owned business, sole proprietor, but operating through a limited company. So as soon as she operates through a limited company, she can't get a sole proprietor loan, but obviously she's protected herself from liability. Steady fixed cash flow outflows in terms of rent payments, utilities, has to buy stock in order to sell it, and naturally during certain low periods of the year would run into a possibility of cash flow shortage. So she came to us from one of our financial institution partners, and although she was relatively new business, not really any history from a financial statement standpoint, what we knew about her is that she was known to the bank. She had a corporate bank account with all the KYC and anti-money laundering searches performed by the bank already. She had roughly a year's worth of what I call, again, electronic verifiable cash flow, both in terms of credit card sales, but also, more importantly, bank account activity. And score all the cash flow behavior through the bank account to get a very reliable pattern of her design a loan that was relevant to the size of needs that she needed, that she required, was relevant to her cash flows, and was designed to be in an amount that she could afford to repay in a very healthy way from future cash flows. So again, character and capacity, which we'll discuss more. So that's just an example of the manner that comes about. Obviously, small business owners don't want to borrow, but they certainly, like, when they need it convenient, fair, and transparent. And this is just one example of that. Talking a little bit, trying to, I guess, picking up a little bit of speed. So obviously, to do what I'm talking about doesn't work on a paper-based environment. There's a platform that needs to come into play, and neatly put, we look at it in sort of three core categories. There's the customer targeting pre-qualification based upon information that exists within the financial institutions. Again, we're talking about businesses that you know who they are because they've already passed your KYC, AML capabilities, and you already have transaction data within your systems. Talk about trying to minimize paperwork on the loan origination process. Wherever there's paper, there's going to be inefficiency. Increasing capabilities now take that paper, whether it's OCR, advanced data analytics, or frankly extracting it directly from databases into a new platform that allows you to do the origination. It's a quick underwriting decision, quick answer, yes or no, and quick disbursement. But as important, in order to do this type of lending, whilst it's easy to push money out, the most important part, in my mind, becomes the management of the portfolio going forward. And because the loans themselves are driven on an origination basis off of the electronic cash flow histories resident in the financial institution, the system needs to then sit in those cash flow patterns going forward, which allows the institution to both effectively manage that particular loan and intervene much earlier than the current model of waiting 30 days for payment and then saying, gee, I haven't gotten paid, what's wrong? But actually being on a real-time daily basis saying, okay, this looks like something's happening here with this client. Perhaps we could step in and be helpful, as often happens with small businesses. But also using the daily cash flow information from each of the individual loans within the portfolio to provide a more macro perspective on the portfolio, trends in the industry that you could predict outlying factors, again, allowing early intervention, all of which feeds immediately back into the credit scoring capabilities for future originations. So as I'm going to talk about in a moment, we talk about the 5 C's of credit. One of those will be conditions, which for short-term lending doesn't usually work. But if you could actually monitor the macro conditions by virtue of looking at the cash flows of all similar-sized businesses, you could actually bring back the macro conditions into a fairly quick decision update on your underwriting capabilities. And finally, from my idea, we're payment processing guys, but we've implemented, my view is what we've done on a system is try to implement core elements of the microfinance sector and the learnings of microfinance, also taking into account payment processing and then data analytics. So to build a platform, you need to kind of put those pieces together. And if you do it, what you come out with is a product that is unsecured, no collateral, works very easily for loans of a year or less, which is a tenor required by most small businesses. For an unsecured basis, certainly, I think profitably can operate from 1,000 to 250,000 or more. Certainly on the low end, I think it would work from 1,000. Our cost structure limits at 2,500, as I mentioned before. One of the key elements is frequent incremental payments on that loan, which smooths the cash flow repayment for the small business owner, but also gives you as the borrower, as the lender rather, daily interaction with the customer's repayment behavior as well. So in our context, we recommend daily banking, daily repayments from the account that has been scored for the cash flow behavior, but it can be done weekly, obviously it can be done monthly, it could be semi-monthly, but the idea is to fix repayments much more often than the typical once-a-month post-dated check type of behavior in a number of markets. And again, in our mind, it serves at least 100+ industry types, and I think it could be much more expanded from there. I'm going to go through this quickly because I realize there isn't too much time, but just to give you an idea what this looks like then for anybody thinking about designing such a system. This is actually a good graph from a recent research on Macquarie talking about the infrastructure of some of the alternative lenders that are out there. Indeed, our own platform would look quite similar. And you still have to look at all the elements that come out of it. And although I think about things in sort of 3 phases, what we're looking at is targeting, i.e. identifying through your customer information which customers would be best suited for loans of this nature, targeting them with specific offers, being proactive, originating, finishing the assessment so that you can disperse the loan, and then the ongoing servicing of that. We could speak about this more in the Q&A, but just to give you an idea, it looks sophisticated, it looks overly complicated, and I suppose in some respects it is, but These are also functions that can be available, implemented manually to some extent along the way, whilst building into the core platform. Certainly in the context of traditional unsecured lending, you as an institution are doing some element of all of this already. This is the idea of what a platform would look like if you brought it together in full detail. With that, I'd like to get into the final poll, which I will turn over to Jessica.
If you want, we can skip this if you'd like to move forward with your presentation. If we're worried about time, it's up to you, or we can continue with the poll, Tom.
Well, for the benefit of the audience, I suppose it would be better that I just carry on then, if that's okay. I'm happy to come back to this one perhaps during the Q&A.
Perfect. Sounds great.
Get into the meat of it, and I realize I've only got a few moments left. So let's talk a little bit more then. We talked. What are the key elements of that credit scoring? And, there's a lot of talk out there, if you read the newspapers and such, about unsecured, social media, magic pixie dust type of technological-driven underwriting, which, those of us in the banking sector look at and say, I understand, this seems systemically threatening. But is it real? Would you really do a loan based on how many people like you on Facebook? And that's not what this is about. This is actually taking traditional, recognized criteria for credit assessment, 5 C's or so, based upon which of those C's you care about the most, and building a loan model on top of that. Now, in my mind, the most important, particularly in an unsecured environment, are capacity and character. Obviously, capacity to repay a loan of a particular amount out of future cash flows. And of course the character is likeliness or the willingness of the borrower to repay, which is very, in my mind, evident by virtue of transactional behaviors in the bank statements or the transaction statements. We also could look at capital, not in the sense of how much equity investment is there, but what other forms of short-termish monies does the business have. So in many of the markets in which we operate, the store landlord would require a deposit of several months of rent. That, to me, would be something that we could monitor and score as a capital investment. What is the length of the time in business that the business has? Certainly, perhaps the longer they've been in business, the more equity investment, the more emotional investment there is. And all that has to be considered in relation to loan size. Obviously, collateral to secure the loan is not directly relevant in this context. We don't have collateral. But conditions becomes an important one. As I described before, when you're monitoring cash flows of all the businesses running through your systems, it gives you a much more real-time feel on the conditions impacting the small business borrowers on the unsecured basis. Still, the bulk of our underwriting capability focuses upon the character and the capacity. To give you another example of that, so another business that we've had, also a woman-owned business, was around for about 6 months and had come for us for a loan pretty much straight, underestimating the amount of cash that would have been involved in getting the business off the ground. And fairly quickly after launching the business, said, we're building up the business, we need to do marketing, we need to make a little bit more investment upon the amount of deposit they had put down for the landlord. Based upon the cash flow behaviors, we felt comfortable in offering a small amount of money based upon, in that case, it's 3 months of actually cash flow information. We were able to do a small loan, which as time went by, cash flows grew. We were then able to continue to top it up. Character of the business was excellent in terms of all behavior that we could see from existing loans that she had declared and her behavior on that. So again, an example of how even a business with less than a year of history could be made into a very viable, profitable business relationship. Amounts of cash of loan relative to cash flow, and then expanding that as the cash flow itself grew. So I'm not going to spend too much time on this because that's coming close, but obviously when we think about a credit scoring engine, where we've gotten it from, in the front end, you do bank statement information, merchant statements, which is the payment account information, loan application information. We give you the sort of the core information. Much of the loan application information in our mind exists within the bank from the KYC standpoint, whether it's date of birth, addresses, prior names, all the other information of what other accounts exist. That tends to exist within a bank, often in different places. The way most people get out to just make them file an application and draw that together. That feeds into a credit scoring engine. You tap out to external sources if they exist in a market, whether that could be social media, it could be credit scoring. Writing taps in again with whatever external sources are needed, produces that loan offer. And that's the essence of what we try to achieve. But to give an indication of the bulk of our scoring, the number of estimators that we have in total, there are several hundred estimators built in, variables, I guess is the word, into our credit scoring. But to give an example of some of the most important of those variables, things that we would look at are the weighted cash flows, weighted, giving us a good idea of the trends of the cash flows of the business, electronic sales versus total sales, cash flow. Electronic sales, to me, have a greater credit footprint in terms of longevity of the business, and so we scale those and weight those differently. And more importantly, security deposit, obviously loan purpose becomes important. As I'm running a little bit short on time, I'll let you just read the rest. These are things that I think as the bankers on this call will say, yeah, that all makes perfect sense. And I think that's the point of this, is that these are things that a bank would traditionally do if it could do it for a small loan term, small loan amount, and utilizing information within their systems on a scalable, efficient manner. The evolution of our own model, so that anybody starting from scratch can understand. Obviously, the first time you start, it's not a heavy technology issue. The first time you start core assumptions, you build in Excel or however else you use it, what those assumptions should be. Then you need to test it by putting real money out there, effectively using a scorecard. Paper-based process, as we've done. And then with more and more information available on your systems, you can turn it into a viable credit score using traditional regression analysis, and then obviously machine learning built upon that, so you can continue to do it. So for our case, we've had 3 different iterations of our credit scoring model. And also to give you an indication of the relative weight we place on some of those key indicators on the left-hand side, you see that more than half of the weight that we apply is relevant to the financial information variables that we described. And cash based and size and volume of transactions being one of the key determinants here. So as I'm wrapping we go, and I definitely want to leave time for Q&A. Just 2 quick case studies. One positive, one negative. And although I've clicked it up, the image on the left, on my screen at least, doesn't look positive. But what that picture in the upper left should be is a traditional Philippine-style seafood platter, indicating a good business. I've spoken of 2 businesses, one, or actually both Hong Kong-based, thus far, both owned by women. This business is a which literally operates in the shadow of some of the biggest banks, has historically been cash only over those 40 years, and as they've often needed, has always gone to the informal economy to borrow whenever they needed. They liked the fact that the informal economy came to them, the informal lenders came to them to allow the lending, the informal lenders came to them to collect repayments, and there was a convenience factor to that. The fact of the matter is these guys were willing to solve the cash flow problems of this business. We got engaged with the business. We helped them actually begin to accept electronic payments by virtue of credit card sales, which, as an aside, helped them increase sales. But the more important part, again, was after 3 months of operation, we were able to say, okay, based upon your cash flow, the electronically verifiable cash flow that we see, we can now extend the loan to you, in this case through one of the banks in the Philippine market. And obviously the pricing and the cost, we were able to offer the same convenience of effectively going to him and saying, okay, based upon your cash flow behavior, we could offer a loan of X amount, and we could offer the same, in fact, better convenience of repayments, because now we will automatically debit on a banking daily basis the loan repayment from the bank accounts into which your electronic cash flow goes. So providing some of the same convenience of the alternative sector in an environment that is fully regulated, operating as a licensed lending company in that market, a distinctly lower cost of borrowing for the small business owner. And since then, he and his family have borrowed on several occasions from us. Again, something that a bank offering that straight away could have done utilizing our methodologies. So it goes to show this is not just a developed world market, but very much something that could work in an environment that is traditionally cash-based, can be brought into electronic segment for transaction capabilities, and can have a very significant benefit upon the business in terms of joining the formal financial sector. Of course, I've given 3 positive case studies that would only be appropriate to finish perhaps and show that people indeed can be declined. And in this particular case, a Singapore shoe retailer requested a significant amount of money. Based on our cash flow analysis on a capacity basis, we felt they could only afford roughly 40,000 Sing dollar type of loan. But more important, the character of the business was a concern. We were able to determine by reference to the bank account activity that there were other loans that was obligated and which were not declared. So a couple of things that we cared about there. One, there were loans not declared, which immediately brings veracity. The fact that there were other loans would have a dramatic impact on the capacity to service a new loan through ourselves in this environment. So as a result, we reported potentially a smaller amount than requested. On a character basis, we concluded this was not somebody with which we wanted to do business. And so a 10-minute mark, so that is what I was told to allow for Q&A, and I'm happy to turn it directly into that. Obviously, our key takeaway: SME lending can be both profitable, efficient. It could be a great way to promote customer loyalty, formal drawing in rather inclusion in the formal financial sector. We think it's a great way to promote financial inclusion, particularly in profitable but good for the borrowers as well, because reducing their cost of borrowing from the informal sector and giving them the capital they need to grow their business. And I suppose the key point is that this is just the beginning. There's more and more data points becoming available. Increase the rollout of these products, these new loan products, in more diverse ways across a broader audience. And obviously, there's some systems to go there, but those systems are increasingly available. And as that becomes increasingly available, the cost of those will go down.
Great. Tom, thank you so much. We do have a few questions, and I'd like to encourage people to go ahead and post any questions that they have, either in the chat box or the question box. And you can also raise your hand, and we can unmute your microphone if you'd like to ask a question directly to Tom. So, Tom, one of the first questions that we've had is, and I think you mentioned this, but if you could reiterate it, what is the average lending tenure, as well as, how does this affect growing businesses? Is there any impact on businesses that are growing at a faster pace in terms of this lending?
Okay, that's an excellent question. I guess in reality, it's 2 questions. So breaking that, the second part, of course, is the easy one in terms of a growth environment. But just to take the first one, the average tenor in our mind, so we think this works very, very well out to a year. In fact, we're looking to extend it now as our own data set grows to 18 months, and then we'll look again to extend it from there. Flow cyclical driven, we think the maximum of 12 months is a very solid base from which to grow and start. Our loans for first-time borrowers would be 6 months, and again, for over 6 months. Unless it's a special situation, if it's a business with multiple locations, for example, which often or shops around the city or so. To me, somebody with 3 shops is far less likely to do a runner in the 6 and default. So unless there's more compelling reasons, first loan is usually 6 months. Then what we often get and build into that capacity, though, is an immediate % of the way through. The different approaches there, but we've concluded over the years that when the business has repaid 70% to borrow back to the default option is the original credit line when they paid 70% of the way through. So in that case, I guess that's 4.5 months into the loan, they're eligible to borrow back. Relationship with us is closer to 9.5 months. So usually they borrow once and immediately borrow again. So that whole the second question, in terms of the growth environment, I think is partially answered by the first question.
Tom, I just wanted to let you know we're having a little bit of a technical problem with your answers. So just it's cutting out just a hair. So as you're answering, I just wanted to let you know that if you could continue to answer the second part of the question. Thank you.
Okay. The second part of the question about growth environments was partially answered, I think, by the first. The point is, as you sit in a cash flow environment, upon cash flow, if you've assigned a credit limit or a credit line based on cash flow over a prior historical period, and if, by the premise we render, you're sitting in the cash flow post-loan disbursement, if that cash flow is showing an improvement, easy to increase in a very linear automated fashion, it's very easy to increase allows a very flexible accommodation. As I mentioned, when a business is 70% repaid, the default expectation from us is that they can borrow back to the original line of credit. However, if the cash flow behavior that we've been monitoring, then actually we would reduce the credit limit available for that renewal. Similarly, if we saw it in a growth environment, we would increase the amount. That answers the second question.
Great. Thank you so much. And we've had a couple questions come in. Obviously, we have a lot of partners coming from Africa, from Southern Africa, from East Africa, South Asia, from a lot of emerging markets. So there's quite a few questions in terms of, what if you don't have some of these electronic payments coming in? If you don't have a lot of credit card sales, if you can't verify it, and also how can you validate sales that are not coming into the bank account? Are you still able to do this lending in some emerging economies where some of the SME business owners may have income, but it's unreported income or undeclared? So maybe there's some alternatives that you can share with us and how this system might work in some of those situations.
Yeah, that's an excellent question, for which, frankly, I only have a partial answer. Our model is premised upon the notion of electronically verifiable cash flow. And that doesn't mean that the cash flow had to have been generated electronically. What it means is that through some system of an electronic manner, you can verify that cash flow. So cash-only businesses which routinely deposit money into a bank account, deposit cash into a bank account, if you're using the bank's ledger, i.e. the bank's statements, to score the character and capacity, I would view that as something upon which we're quite comfortable for our underwriting decision. When we have businesses who make applications through our system, and it's very apparent that they are not depositing cash, for example, or if they say to us, well, how come you only approve me for that amount? I'm really doing a lot better. I actually view that as a negative, particularly in environments where you're supposed to be reporting your taxes, you're supposed to be paying VAT. So Part of the answer is for business owners who choose or simply because services are not able to join the formal financial sector. I don't pretend that our model works for that. I think there's lots of experiments going on with other ways of looking at electronic activity. And the electronic activity is what allows the scalability of this to happen. That's the key on it. But I certainly think the trend going forward is that there will be a lot more electronic footprint upon which both ourselves and certainly many of the companies that are exploring alternative ways of doing similar activities. The trend is certainly much more electronic footprint. What I'm suggesting is that where we started 6 years ago was electronic payments and from the credit card background, given our own pedigree and history, but we ourselves have expanded it to a much broader interpretation of electronically verifiable cash flow. So that's both a general answer and perhaps an unsatisfying answer. These are, in fact, early days. There are certainly growing across the board electronic payments in many, many markets. Certainly markets in which we operate, when we talk about countries as big and diverse as the Philippines, the reality is we offer our capabilities around the major cities because in those markets there's a higher likelihood that the business will either be engaged directly in a certain amount of electronic sales and also that they may be making deposits of cash into the bank accounts. Certainly it motivates the behavior of small business owners to utilize the formal financial sector. If you could say, stop hiding your cash transactions, put it into the bank, and we can reward you with a line of credit. So we think the motivation there is beneficial. I am certain that the trends at a very macro level in all markets of any degree of development will mitigate in favor of the type of underwriting capabilities of which we speak.
Right. Yeah, that's very, very helpful. Maybe you could talk a little bit more about, you know, how AMP works, you know, with a bank. On your last slide, you had talked about, you know, there was an opportunity for banks to either build some of this on their own or else to do some outsourcing. So there's obviously a lot of questions, you know, about how much data a bank would need, how long it takes to put together. So maybe talk about some of those options for the financial institutions.
Okay, well, I'll need to apologize up front because this will sound like a sales pitch for AMP Credit Technologies. But it's precisely that we built the platform for. The information, the core information, which is utilized for the targeting, the credit modeling, and then the subsequent loan servicing, all of that information exists, or most of that information exists within bank systems. That's our core premise. However, the bank systems themselves tend to be split between different business units supporting different P&Ls, usually different legacy environments. And so in theory, this is something that a bank could do by itself if it wanted to go there, and certainly with enough time and money, do some element of what we're we believe that on a technology outsource basis, it's far more efficient for a bank to utilize a platform such as ours. So what we do is, in fact, we have a platform that interfaces to the different databases within the bank to enable all of this to ask a bank to do any development, because I think that immediately has cost implications and immediately delays the project. What we have always done in capacity to describe before is design a platform that actually maps to what the bank's existing data formats systems, processes it for the purposes of the credit decisioning, and feeds the information back to the bank. So effectively, we run the portfolio management system on our side. We do the credit scoring on our side, but all of the monies reside within the bank. The bank controls the product, and effectively for the bank. That's the core model, and the bank pays a setup fee and then basically a usage fee based upon anticipated loans going through the system. I'm very happy to speak with any of the businesses on this call about how we can offer our software as a service model to those institutions.
Tom, thank you so much for this excellent presentation. We had quite a few financial institutions join, and we do have some other follow-up questions that we haven't had time to get to. Tom, I think on your next slide you have your contact information on there if you want to pull up that slide. And if anyone has any other questions, I'd like to encourage you. We'll post some of these on our LinkedIn group, our Small Business Banking Network LinkedIn group, so please go to that, and hopefully Tom can engage with you there, and we'd be happy to connect anyone with Tom who has any further questions about AMP. So thanks again to our participants, and thanks again to Tom.
Sorry, I'll just say I'll be very happy to answer any questions along the way. I know we covered a lot of material, and I'd be very happy to take offline any questions anybody has.
Great. Thanks so much, everyone. We appreciate it, and have a wonderful rest of your day.